In this session, we will focus on estimating the liquidity risk. Nowadays, apart from the credit, market, and operations risk, there is a lot of focus that is revolving around the liquidity risk. So, how do I compute the liquidity risk? For which there is a specific mechanism of computation called liquidity adjusted VAR LVAR. So it has gone to that level. Normally, while computing the market or credit or operations risk, we were computing the market VAR, credit VAR, etc. But today, we also need to look out for computing the risk that is associated with the liquidity. There are various mechanisms to compute this liquidity adjusted VAR. So we will mainly focus on the mechanisms that are used to estimate this liquidity adjusted VAR in this session. So whenever I talk about the liquidity risk, the key thing that comes to my mind is any borrower, or from that perspective, any trader not being able to trade the security at the appropriate price. So there might be a quoted bid price or ask price, right? But I may not be able to trade my security at that particular price. It may so happen that the bid price may come down and the ask price may typically go up. So this may result in general, whenever we are having such kind of scenario, the bid prices may generally go down and the ask prices may go up, which is a scenario where the spread between the bid and ask can get more and more wider. That is where we are saying we are exposed more to a liquidity risk. And in case forcibly, see, generally it's the case, right? Let's say I am not able to sell my particular property. It may so happen that I will reduce the price and then only I should be able to sell the property. So there is some kind of cost that is getting into exit out of the position. Or let's say if I want to buy a particular property, I may not be able to buy it because there is no active market that is involved in it. So if there is no active market, I may be forced to buy it. If there is no active market involved for it, probably it will take too much of time for me to buy, or probably I may have to pay slightly much more to really buy it. So there is a mechanism where we are talking about the spread getting more and more wider, high costs in case I have to exit that particular position, and I don't even know at what price that particular transaction gets executed. Yes, I want to sell off my property. There is no active market for it. So I'm not sure at what price I will end up selling up the property. I may compromise on the price, but to what extent? What would be the new price at which I can sell off my property? That is what creates a big liquidity problem. And generally it is more based on the market in which it is operating. The key characteristics of the market. Is there any active trading involved in it? How many traders are typically present? So is it very few traders, or the number of traders is very large? When I am talking about traders being very large in number, there might be a possibility of very active trading market. And when there is an active trading market, the scope for liquidity risk is much lesser and liquidity itself will be much higher. So, and we are also talking about the frequency of transactions. Okay, there may be thousands of traders, but how frequently they are trading? Is it on a almost on an intraday basis or daily basis or weekly, or what is the frequency at which they are getting into buy sell transactions, and what is the size of the trade? Are large volumes getting exchanged quite frequently? The more and more larger volumes at more and more higher frequencies means there is a lot of liquidity existing. So the scope for liquidity risk will be much lesser. So that itself again will boil down to how much time it is taking to execute a trade. Is it very quick, or from the time I get into a buy order for the entire settlement to happen, probably is it taking a few months itself? So the larger the time it is taking to execute the transaction, the higher is the liquidity risk that is associated with it. And what are the intermediate transaction costs, the brokerage fees, or any other transaction costs and taxes that are involved in the process? So if the taxes and all are very high, probably the liquidity may not be so high, which will cause liquidity risk. Whereas if the taxes and transaction costs are very much negligible, people get into active buying and selling of the securities even for small marginal profits also. So which means the liquidity will be high in those kind of situations. And there could be some kind of risk. So understanding is required with respect to what is the risk that is involved with an incomplete transaction. And even the standardization of an asset influences the liquidity. Probably look at futures versus forwards. The scope for exiting out of a forward position is much more difficult compared to exiting out of a futures position, because in a futures position offsetting is quite simpler, and I can exit out of my position quite comfortably. One, because the asset is more or less standardized, whatever is trading on the exchange, there are numerous buyers and sellers associated with it. So even if I exit out of a buyer position, someone else will enter into a buyer position, which means because of the active market that is involved for the futures, the liquidity risk is much lesser for the futures market compared to a forward market. Finding a counterparty and exiting out of the position is quite difficult when we talk about a forward contract. Similarly, the mechanism where it is traded also, like exchange traded contracts generally have high liquidity and hence low liquidity risk, whereas over the counter kind of transactions, they definitely have higher liquidity risks. So these are some of the things that we need to understand when we talk about the liquidity and factors that are impacting the liquidity and leading to liquidity risk. Then the next thing we need to talk about is the role of bid ask spread. This is a big measure of liquidity and the liquidity risk. We also call it as the cost that is involved with respect to the liquidity of the transaction. The higher the liquidity is, so liquidity, we need to differentiate between these two words. If the liquidity is higher, liquidity risk is lower. Liquidity risk is lower, the bid ask spread will be lower. A straightforward relationship means the liquidity costs are lower. Otherwise, it is the other way. If the liquidity is lower, liquidity risk will be higher, the spread will be wider, means your liquidity costs associated with the trade also will be higher. Now, from an analyst dimension, even these kind of changes need to be included as a part of the financial model or the risk model that is getting created, because the higher the liquidity risk, the higher will be the cost of trading. So these things also should be determined by the model in quite a good amount of detail. And when we talk about this liquidity risk, we are trying to look at it from the two dimensions. One, we call it as exogenous liquidity. The other is called treated as endogenous. A very interesting aspect of exogenous is whatever is the spread. See, the bid versus the ask, the buy versus the sell, the buy price. So this generally the words, just to give a clarity, the bid and the ask. This buy price, the bid is the price at which the dealer buys. Dealer buy price, dealer sell price are called as bid and ask prices. So from investor's perspective, the bid is the sell price, the ask is the buy price. So what we are saying is, the investor wise, if the asset is more and more illiquid, he may have to sell it at a lower price. But if he has to really buy it, he has to really pay a high premium to buy that. So that is the reason we talk about the bid-ask spread getting widened. Now what we are saying is, if one individual trader, because of the trade that he is placing, see, generally when I do more and more buy orders, the prices may go up. When I do more and more of sell orders, the prices may go down. So even when the prices are going up or prices are going down, that will have an impact on the spread, because if let's say someone has placed a very huge sell order and because of that the price has fallen down, and the selling price has gone down but the buying price did not change, which means the bid ask spread has increased. So in some cases what could happen is, based on the volume of the trade that has been placed by the trader, it may very well result in the bid ask spread widening. So what we are saying is, if one single trader, if the trade placed by one single trader is impacting the bid ask spread, is increasing the spread or is widening the spread, that is what we call as endogenous liquidity. But if you say that, yeah, the trade placed by one small trader or one or few traders, it does not influence the price and hence the bid ask spread, that is what we are calling as exogenous liquidity. So small spread is not affected by individual trades, especially this we can say that those kind of traders generally are small time traders whose trades do not impact the prices at all, and that means the bid ask spread also does not get changed because of them. Whereas when we talk about endogenous liquidity, even an individual trade will influence the price heavily, which means the spread also gets influenced very heavily. So generally we talk about the large transactions, a huge buy or sell, a very large transaction. If I have to sell a very large asset with so many units of it, then probably I may have to compromise on the price and sell it at a much lesser price itself. Or if I have to buy it, I may have to pay higher to purchase it, because there are no ample sellers that are available in the market. So to lure the seller to sell it, I may have to pay a higher price to purchase it. So that is where, if one large trader, because of the buy or the sell position he is creating, he is able to dominate or influence the price, which in turn is impacting the spread. That is what we are calling as endogenous spread. So in that case, we see that the bid price will fall, means the price at which I want to sell will come down. The ask price will actually increase. And this kind of endogenous spread also needs to be considered as a part of building of the financial model for assessing the liquidity risk, because liquidity risk we have an exogenous factor as well as endogenous factors, so they need to be considered while computing the liquidity adjusted VAR or any other liquidity related risk measure. Now, getting into the process of liquidity adjusted VAR, right? It is nothing but whatever is the original value at risk using any of the mechanisms. This value at risk currently, whatever the, whether it is market VAR or credit VAR or any of them, it does not incorporate the factors of liquidity into it. Whatever the way the VAR model is derived, it does not incorporate the liquidity into it. So which means the when I have to really look at the liquidity part and improvise my VAR, we are calling as LVAR, liquidity adjusted VAR. We'll see in the next few slides on as to how we are actually computing the liquidity adjusted VAR. Again, there could be various mechanisms that could be available to compute the liquidity adjusted VAR. Some of them may be very basic mechanisms and some of them may be very advanced, sophisticated kind of mechanisms, which may be time intensive, cost intensive, lot of things. Now, the first thing that is necessary for me is to which one of these two needs to be chosen. So one thing we have to understand, if it is a sophisticated model, very advanced complexity is being incorporated into the model, it doesn't mean that it will suit my purpose, right? In some cases, even a very small, simple model also can suit the purpose much better, or probably I will call it as a trade-off. Right, you really need to decide whether you want to go with a sophistication which is high cost intensive and all versus ease of implementation. So generally people start with the original VAR models and try to include some kind of adjustments which talk about the liquidity. For various factors associated with the liquidity, people start with the regular VAR model and then make some kind of adjustments to that rather than building a model for LVAR right from the scratch. And the other thing is, okay, I'm building a liquidity based VAR model by bringing in some kind of liquidity adjustments to the overall VAR. But what I need to look out is for the compatibility, right? Probably by using a complexity kind of scenario, if my original VAR itself is getting impacted, then there is no point in adding up the additional add-ons, liquidity based add-ons to that particular model, because the original itself is getting badly impacted. So sometimes people even say, in some cases, rather than choosing a big sophisticated model, you can think of choosing two less sophisticated models, which might be better than one fully sophisticated one. And in some cases, what could happen is the introduction of the liquidity adjustment factors could be very much correlated with the other inputs. Let's say in case of regular computation of VAR, we might have considered the holding period, the risk metric, the confidence level. Now, what we are saying is, it might be possible that the liquidity adjustment that we are choosing by whatever mechanism, liquidity adjustment, whatever we are choosing as an additional factor that would go into the determination of LVAR. So if this is an additional factor, logically speaking, with the concept of regression, these two really need to be independent. But if they form interdependent, if the independent variables, whatever I'm talking of, those two have some kind of correlation that is existing between them. I really need to understand that level of sensitivities, to what extent my other inputs are getting affected because of the introduction of this liquidity adjustment. So what is generally suggested for computation of LVAR is whatever the model we are using to compute, whatever may be the formulas and the mechanisms that are getting used to compute the LVAR, compare it against the real world data. Whatever is your model driven output, compare it with the real world data, perform stress testing, means change the inputs quite drastically by some parameters, and see how the outputs are getting changing to this input. Or sometimes you can even perform a back testing on the historical data, try using the model and try to compute the values. So apart from that, it's always advised that if you are able to follow multiple approaches for multiple kind of liquidity concerns, it would definitely be a add-on. So this is something which we need to keep in mind before getting into the process of computing the liquidity adjusted VAR itself. Now we actually get into the real computation process for this LVAR. So there are actually three scenarios that we will talk about for computation of LVAR. One, assuming that the spread is constant throughout. Assuming that the spread is constant forever, right? Whatever may be the trade that is happening, the spread is not going to change quite drastically. So we are looking out for a constant spread kind of stuff. Then we look at exogenous spread, where the price is not getting that badly affected because of one or few traders positions. And then we also look out for endogenous spread kind of an approach, right? So when I am assuming a constant spread, so forever this model assumes that the bid ask spread is constant. So this is the bid ask spread. Now from that mechanism, what we are saying is, if at all I have to compute the liquidity cost, I take half of the spread and multiply it with the value of the position. So if at all my value of the position, if at all my value of the position is 100 million, okay, so we are first talking about the liquidity cost is half of the spread times the value of the position. Okay, let me take a small numerical to understand that. Let's say the value of my position, right? I talk about the market value of a position. Let me take the value of the position is 100 million, right? And if I am assuming that the bid ask spread is 2.5%, right? The bid ask spread is going to be 2.5%. Then obviously if I want to find out the liquidity cost, all I am saying is 0.5 times the bid ask spread times the 100 million, which is coming out to around 1.25 million is my liquidity cost. Now this liquidity cost generally I add up to the VAR to compute the LVAR. So LVAR is nothing but, in simple terms, LVAR is nothing but the VAR plus liquidity cost. Now for this example, I have got my liquidity cost as somewhere around 1.25 million. Now what I will try to find out is the LVAR. Now the moment I know my VAR, I'll add the liquidity costs and compute the liquidity adjusted VAR. And whenever we talk about the spread, right, probably here I have used the spread as 2.5% directly, but otherwise spread is nothing but the ask price minus the bid price divided by the average of the ask and the bid prices. So this is the mechanism to find out the spread. So now let's say the ask is somewhere around 65 and bid is around 60. The ask minus bid by ask plus bid by 2. So somewhere around 8%, if at all the ask minus the ask is 65 and bid is 60, the bid ask spread is what we actually call as 8%. So that's the way we compute the spread. So in case even if I don't know the spread and if there is a quoted bid and ask price, we can associate that by doing this kind of a calculation. Now the most important thing is the VAR. We know that the VAR depends on the assumption of the distribution of the asset. So the assumption whatever I am making relating to the distribution of the asset, the VAR is depending. So generally we look at either a distribution assuming that asset returns follow assets prices follow a normal distribution, or sometimes we look at a log normal distribution. So when we are talking about a normal distribution, we know that the VAR is nothing but whatever is the standard deviation into the confidence factor, Z alpha. So this is what is my percent. So if I am taking standard deviation in percentage terms multiplied by Z alpha, that is what is my VAR. So if I have to find out my dollar based VAR, I will multiply it with my the position of the whole value of the portfolio position. So that's where we are saying the normal, when I assume that the asset prices follow a normal distribution, I am saying that my VAR is going to be this much. So if I am talking about a 95% confidence interval, then probably this Z alpha is going to be 1.65 and whatever is the standard deviation of the asset return. So let's assume in this case if I require the standard deviation of asset returns, asset prices, or standard deviation of the asset prices or asset prices, let's assume that it's around 2%, right, and 95% confidence interval is what I require, then directly I'll compute its VAR as 1.65 times this 2% times this 100. So which is coming out to around 3.3, and when I am doing a liquidity adjusted VAR, I am adding this VAR plus the liquidity cost coming out to 4.55. That is, so my original VAR in this case is 3.3, whereas the liquidity adjusted VAR is becoming 4.55 million. And an interesting calculation here. Okay, this is the normal, and probably the total, the other way I can look out for the LVAR formula is nothing but the V times sigma into Z alpha plus the liquidity cost also requires 0.5 times the spread. This is how we can write the liquidity R position here, right? And otherwise people also write it slightly differently. L var is equal to var plus 0.5 times the spread, right? So I divide both sides by var. This is one more way people look at it. So L var by var is an important ratio that is typically computed here. We call it as 1 plus zero point 0.5 times spread by var. Very important relationship here. And the var is coming out with V times, right, V times sigma times Z alpha. Now here I can make out, if the spread is increasing, obviously my L var to var ratio is increasing. If the confidence interval, right, if the confidence interval is decreasing, then this value is going to increase, because if the confidence interval is decreasing, Z alpha will go down. Z alpha going down, this entire ratio will go up, means L var to var ratio will go up, which means the liquidity contribution, liquidity risk, probably the liquidity cost or liquidity risk will increase. One, as the spread increases. Two, the confidence level decreases. Three, the standard deviation decreases. Generally, when we talk about the longer times to maturity and all, we can see that the spread decreases. If the holding period is decreased, for a smaller holding period, we see that the sigma value will be much lesser. The larger the holding period, the sigma value could be larger. Smaller the holding period, the sigma value will be much lesser. So which means the overall ratio is going to increase, which will increase my liquidity risk. So we should consider that these are the three factors. One is increasing of the spread, two is not with an increase in the significance level. Let me talk about as a decrease in the significance level. If the significance level is decreasing, Z alpha will definitely Z alpha will decrease, means the ratio will increase. And similarly, the sigma will, if the sigma is decreasing, sigma when it can decrease, the holding period is much smaller. So in all these cases, we see that the liquidity adjustment is going to increase. Now, one more small thing is, if at all I don't assume that var is a normal var, I look out for the same thing as a log normal var. So, in case of log normal asset returns, what is the formula for your var? In case of log normal returns, your var is going as not sigma times Z alpha times V. That is your normal way. But if it is log normal, so what we generally take is the var is 1 minus e to the power of mu minus sigma Z alpha. That is what is the log normal var. Because the logarithm of this will follow a normal distribution. So what is the logarithm of this? This is 0, and logarithm of this is becoming mu minus sigma Z alpha, and probably minus of. And if mu is 0, this is becoming sigma Z alpha itself. So the log normal var is this much. So, and of course multiplying it by the V factor, which is the value of the portfolio. So this I will add up with the liquidity cost, 0.5 times the spread times V. So in case of log normal var, the liquidity adjusted var will come out as 1 minus of e power mu minus sigma z. So if I am assuming that mu is 0, which is nothing but the mean returns are 0. So in the same example, if I assume that this is following a log normal distribution, then what would have been my var if it is following a log normal distribution and assume the same mu is going to be 0. So this is going to come out as 1 minus of e to the power of mu is not there minus sigma times z alpha 1.65. This multiplied by v. This is my log normal var, which is slightly lesser than the regular var in this case. And of course, when I compute the L var, in this case it is nothing but the var plus the liquidity cost. So the log normal var is also based on the log normal var, the L var is also liquidity adjusted var is also slightly lesser in this case. And here also I can try finding out the liquidity adjusted var to var ratio. The simple logic liquidity adjusted var to var always is 1 plus spread divided by var. So in other way it is nothing but 1 plus 0.5 times whatever is the calculation for the spread. So right, 0.5 times spread times V divided by or liquidity cost, see 1 plus L var equal to var plus liquidity cost. I divide by var across, this becomes 1 plus liquidity cost by var. Liquidity cost is 0.5 times spread times V by var in this case is 1 minus e power mu minus sigma z alpha times V. So this is going off. So overall this is coming out as 1 plus spread by twice 1 minus e power mu minus sigma z alpha. Here also the same logic goes up. L var by var, which is the contribution of liquidity to the overall var, that increases if the spread increases, if the confidence level decreases, and if the holding period decreases. So this kind of thing we need to understand while computing the L var. But in this entire thing, we are making an assumption that the spread will not change at all. Right? The spread will not change at all. And in the same example, let's say I want to compute the L var to var ratio. L var to var ratio, I can take L var and divide it by var. So this is what I'm going to get 1.38. So almost 38% additional contribution is done by the liquidity adjusted var to the original value at risk. Then now we can also look out for an exogenous spread approach. Right, here it's a constant spread. Here we take that the spread is stochastic. So the spread moves as per a particular distribution. It could be a normal distribution or it could be any other fat-tailed distributions, log normal kind, whatever it is. You assume that the spread is following a particular distribution and you try to compute based on the mean and the standard deviation of the spread. Here two different things come. The mean and standard deviation exists with the underlying asset also, and the mean and standard deviation associate with the spread also, because in our earlier approach we have taken that the spread is constant. Here we are taking that the spread is not constant, right? Earlier I have taken, let's say the spread is 2.5%, but now what I will say is, yeah, the spread, the mean of the mean spread is still 2.5%, but there is a standard deviation of the spread. The spread is having some level of standard deviation also, let's say around 0.5%. So the mean of the spread is 2.5% only, fine. It's not constant. There is some level of fluctuation that is associated with the spread. So with the spread is changing with a standard deviation of around 0.5%. If I am looking at from that dimension, we call that as an exogenous spread kind of an approach. So in that case, the liquidity cost is simple. Earlier we were talking about liquidity cost as 0.5 times the spread times V. So here it's only the spread, because it's a constant thing. We are directly taking the spread as half of the total spread between the ask and the bid prices. But here we are taking it as, instead of directly taking the spread as it is, we take 0.5 times V and then take it as mean plus Z, probably I call it as Z dash times the standard deviation of the spread. So the only thing is, probably if sigma is 0, means no volatility to the spread, then it is nothing but the mean spread itself, right? So the mean spread itself is what is getting considered in this approach. So if at all there is some kind of volatility, we are adding that additional volatility factor here. So, but this confidence parameter Z dash can be estimated by the modeler. Either there are various, I assume a distribution, based on the distribution for V as well as spread, get into the simulation part, and then incorporate the spread into V itself, into the value of the portfolio. Because of the spread, what is the impact on the value of the portfolio, then find out the prices and then find out the LVA. So here at least the liquidity cost can be computed using this mechanism, which is slightly an additional. So in the same example, if I have to compute the additional liquidity cost now, assuming exogenous spread, if I have to take my liquidity cost, all I am considering is 0.5 times V times mu. Mu is 2.5% plus Z dash. In general, people take this Z dash as an estimated parameter. So it's not a confidence parameter associated with 95% or 99%, because here the distribution need not be normal. So I cannot take 1.65. Right, even if I am saying 95% spread or whatever, confidence level is still 95%, I cannot take 1.65 because the spread need not follow a normal distribution. But if it is known that the spread is following a normal distribution, then I can take 1.65 itself for Z. Otherwise, sometimes if I see that it can follow some kind of fat-tailed distribution, I can take that Z as around 2.5 or 3 or something like that, depending on what kind of distribution I am assuming for that Z associated with the 95% area. See, when we talk about a normal distribution, probably the 95% may be somewhere here, the 5% area. But when I am talking about some fat tail kind of distribution, it may so happen that the 95% may be somewhere here. So it may go slightly higher also as a part of the 95% interval. So from that standpoint, we may take a slightly higher 2.5 or 3 kind of stuff corresponding to the standard deviation. So that is what is resulting in the liquidity cost being this much. So now the LVAR, the modified LVAR is going to be the initial log normal VAR plus the liquidity costs associated, and the updated LVAR by VAR ratio this time is going to be this much divided by the LVAR divided by VAR, which is giving me almost 61%. So almost from 38.5%, this LVAR to VAR ratio has gone to the extent of 61.6%. So that is what is the excess that is coming in by assuming that the standard deviation of the spread is somewhere around 0.5%. So that is how we incorporate the exogenous spread as a part of our liquidity risk computation. Then the next thing I am trying to look out is the endogenous price approach. Means we are even assuming that the price will change because of the trade. That is what we call as endogenous. One single trade or one large trade can influence the prices quite drastically. So when the price is changing, obviously the liquidity factor also keeps changes, because let's say when the price is falling quite drastically, that itself could create a liquidity risk. So whatever is the changes in the price, if I am considering as an addition to my liquidity risk, that is what we call as endogenous price approach. And the way we compute the endogenous price approach is look at the elasticity. Elasticity is nothing but the change in price, the percentage change in price divided by the size of the trade. That is what we are calling as elasticity. Means the higher the trade, the higher is the size of the trade. I may assume for some securities the price change could be very high, or in some cases the price change could be very low, and that is what is the deciding factor. So even if the size of the trade is very high, it may so happen that the price may not change that drastically for some securities which are very actively traded or something. In those cases, the elasticity is much lower. Whereas even if the size is slightly lesser, if we see a big change in the price for a particular security, then the elasticity will be higher. And in general, what we observe is the price change will be negative, and in common scenarios this is going to be positive, so which may result in elasticity always coming out to be negative. But what we need to understand here is whatever is the size, I estimate probably from a particular trader, if Mr. X is executing a trade which contains 10% of the total number of shares, and then I observe what is the change in price for that position. So whenever I am trying to compute the LVAR, all I am saying is the VAR times 1 minus proportionate change in price. So what is the proportionate change in price? The elasticity times delta n by n. So probably I'll write LVAR is equal to VAR times 1 minus of this. So what is it saying? The higher the size, depending on the elasticity, generally elasticity is a negative number. So this is 1 minus of minus number. So 1 plus that high number will be added. So LVAR to VAR ratio is going to increase. And easier thing is LVAR to VAR is nothing but 1 minus proportionate change in price, which is nothing but elasticity times the size of the trade. So my LVAR to VAR means contribution of liquidity to the overall VAR is purely based on one, the elasticity between the price change and the size of the trade for that security, which has to be estimated using an appropriate method, and also delta n by n, which need not be estimated, which can be understood from the size of the position that is getting traded. So with this two inputs itself, we are able to compute the LVAR to VAR ratio. The good thing is LVAR to VAR does not depend on the VAR computation, right? It does not depend on the VAR computation model. It is purely dependent, whatever is the mechanism you are using for your VAR, right? What we are trying to say is, here you see LVAR to VAR was 1.61 when we have gone ahead with exogenous spread approach and a log normal VAR. But if I had gone with a normal VAR itself, what would have been the LVAR? When I had gone with a normal VAR approach, my LVAR is VAR plus the liquidity costs, right? So in this case, the LVAR to VAR ratio is this divided by this. This is around 60.6 only. Means what I am trying to say is, depending on the VAR calculation that is used, especially in case of exogenous kind of approach, or in case of constant spread approach, what we are seeing is the LVAR to VAR ratio or contribution of LVAR to the VAR is dependent on the VAR calculation approach. Depending on whether I am using a normal VAR or log normal VAR, the ratio of LVAR to VAR ratio is changing. But when I look at the endogenous price approach, the LVAR to VAR ratio is straightforward. It is 1 minus of the elasticity times delta n by n. So it is not dependent on the the assumption about the distribution of the assets for the calculation of VAR. It is purely dependent on the elasticity of the trade and the size of the trade. But of course, this has a few more drawbacks, that it does not consider the transaction costs and the bid-ask spreads. But the good thing is, let's say I have one exogenous, let's say this using the exogenous spread, I got this as my LVAR to VAR. And with the current mechanism, let's say using an elasticity of minus 3% and a 10% trade. So 1 minus of, right, 1 minus of minus 3% into 10%. 1 minus of minus 3% into 10%. So let's say 1.003, right? Or probably I assume that the elasticity is minus 0.3 instead of minus 3%. If I assume that it is around minus 0.3, so I'll take it as, instead of this, I'll take it as minus 0.3. So overall there is 1.03. That is the LVAR by VAR because of the endogenous risk. So LVAR by VAR because of endogenous risk is going to be that much. So what I can very well do is, if the exogenous is around 1.6, so the overall LVAR is nothing but the exogenous LVAR, which is 1.6, multiplied by the endogenous LVAR to VAR ratio. Sorry, this is LVAR to VAR ratio itself. The exogenous LVAR to VAR is 1.6. The endogenous is 1.03. I can simply multiply to get the updated LVAR to VAR, wherein I am considering both the exogenous as well as endogenous. And there is a small improvement over this even an endogenous approach called as the liquidity discounted VAR, which is more of a sophisticated kind of a model, wherein it says, okay, first try to understand what is the holding period, because what we have discussed in the earlier exogenous and the constant spread approach is the lesser the holding period, the higher is going to be the liquidity adjustment to the VAR, because lesser the holding period, there is a good chance that the standard deviation could be lesser, and if the standard deviation is lesser, then LVAR to VAR ratio is going to be higher. So first try identifying an appropriate holding period based on the traders. Okay, what is the that particular holding period that really maximizes his utility function. So identify a holding period that maximizes the utility function for the trader, and corresponding to that trading period or holding period, identify the liquidity discount and add it to all the losses, simulate it, and make sure that the volatility that we are considering takes into account the time factor, the liquidity discount factor, as well as the asset. So this can be only through a modeling kind of an approach using all the various assumptions. But yeah, may be sophisticated, but at the same time may have limitation in terms of fitment to use. But this is another slightly different model that has been proposed to come out with the liquidity adjusted VAR, which even takes into consideration both the exogenous as well as the endogenous kind of factors. Then another important dimension on the same lines is how would the transaction costs as well as the market price play a role on the based on the liquidation strategies. Let's say I'm liquidating something very quickly versus taking time to sell it. If I'm trying to sell the asset quite quickly, obviously the transaction cost may be much higher, but the price, I may be able to sell it with the current price. I may not compromise too much on the price, but the transaction cost, I may have to do a lot of advertising for it. I may have to probably pay a slightly higher broker fee. The transaction cost may be much higher, but the price of the underlying may not be that falling drastically, because I'm trying to sell off within no time. So price wise, I may not compromise too much, but probably the intermediation cost, the transaction cost, and the advertising and various other costs to sell that asset, which are the transaction costs, they may be much higher. So probably looking at from a trader profile or trader characteristic perspective, it is said that this kind of sell-off is very much comfortable for a high risk averse trader. He is not willing to take too much of a risk, but he is ready to give some kind of transaction cost. He is ready to bear some kind of transaction cost, but he is not willing to bear the uncertainty in the prices at a later point in time, because probably if he is not able to sell today, wait for a couple of more days, it is very much possible that the prices may fall drastically and he may be forced to sell that security at a much lesser price. He does not want to take that kind of a risk. So those kind of traders generally get into the process of selling the asset quite quickly. Whereas on the other side, we talk about less risk averse kind of traders or more risk loving kind of traders. What they take is they may take more time to sell. Of course, there they may be exposed more and more to the exogenous increase in the prices, or price uncertainty is something that can very well come up, but they will not incur huge transaction costs. So it's here there is a compromise between the price fall and the transaction costs. So which one you want to bear more and which one you want to reduce? So the price fall, I mean the risk taking trader wants to experiment here, because if the price does not fall, he is ready to sell it at a higher price. So he is very willing to bear that extra risk. But when I am talking about risk averse kind of a trader, he may not be willing to bear the additional price fall, so he is ready to compromise by involving slightly higher transaction cost. That's one more dimension that we need to understand in the process. Then the other mechanism is computation of liquidity at risk. Just like the way we compute value at risk, nowadays we are talking about the liquidity at risk, which is also otherwise called as the cash flow at risk. So just like the way we define value at risk, the maximum loss, probably if I replicate here, maximum loss during a time period at a specific confidence interval. That is what we called as VAR. When I say LAR, liquidity at risk, the maximum liquidity, so the way we are defining the liquidity is cash outflow. The maximum cash outflow during a period at a specified level of confidence. So I may talk about 95% LAR, means there is a 5% chance that the cash outflow during that particular period will be more than that specified amount. So if that amount is positive, we talk about an outflow to be existing. If it is negative, we say that there is an inflow. It might very well be possible that there may be two positions. Like, okay, I have a market risk with me, right? Which means nothing but I have a portfolio. I have a portfolio of assets which are exposed to market risk. So I want to try to hedge this. I can think of hedging it with a futures position or with an option position. What might very well happen is when I am hedging it with a futures position, or probably I have a short position in a portfolio. So I am going either with long futures or even long anything. One position I am trying to hedge with two different securities. Here there might be a possibility that I might be exposed more and more to margin calls, means some kind of cash flow, intermediate cash flow problems could be there. Whereas here I may not be exposed to any margin call. Let's say we are talking about a European call, a European option. I'm not exposed to any kind of margin calls here. Right? Probably I have a long position itself. I would have taken a long put position, or I could have gone for a short futures position, whatever it is. So here I will not have any margin calls, right? Because of that, there may not be much of intermediate cash flows in the process at all. So this particular process may not have too much of VAR because it is getting mark to market on a regular basis, but it may be exposed more and more to the liquidity adjusted risk or liquidity at risk, because the margin calls could result in huge cash outflows sometime in the middle. Whereas when I talk about this position where there is no intermediate cash outflow, only on the maturity date we are talking about the cash flows, it may not be exposed to LAR at all until the maturity date or the expiry date. But it is definitely getting exposed to VAR heavily. So what we are saying is it may be two positions which may be more and more similar with respect to market risk, but there may be big differences with respect to the liquidity at risk. So this is something which we may have to consider while choosing our appropriate strategy. So wherever there are some kind of intermediate cash flows possible in any kind of transaction, we are getting exposed to the law. Any kind of loans given or taken where probably some kind of cash flows might happen during the holding period, cash inflow or outflow happening during the holding period, and if the company's position is not sufficient enough to pay those cash flows, that is where the liquidity is getting increased and liquidity is getting decreased, and liquidity at risk is increasing. Similarly, any positions which you have got into where there is a daily mark to market settlement and margin calls kind of thing existing, so there might be a possibility of cash flows somewhere in the middle, which means LAR can exist there. Any kind of collateral obligations which can result in either you depositing more securities or more cash sometime in the middle because the value of the positions have gone down, even that could create cash flow problems. So that is also a scenario of liquidity at risk. Any bonds with embedded options, either convertible features or callable features, where they may be called back and cash flows could change during the process. All these things are probably a credit downgrade. The credit downgrade also might result in might result in the position getting more, either more collaterals getting deposited or those kind of stuff, which could again impact the liquidity, because the bank may face a problem in terms of raising additional capitals, and the whole short term liquidity crisis can come up. All these things are influencing your liquidity at risk. So how do I compute this? Sometimes people start with the existing VAR models itself, make some kind of adjustments like your endogenous spread based or exogenous spread based. Some kind of adjustments are made to the VAR to finally compute your liquidity at risk. But this could be an ad hoc process, and this might bring in, or this might punch in some kind of model risk into the model because of the wrong usage of the model. Otherwise, I could try building some sophisticated models which are more and more specific to the liquidity at risk, understanding the different types of cash flows, what kind of cash flows are certain, what kind of them are uncertain, which of them are conditional, which of them are unconditional, build a kind of variance covariance approach around the different sets of cash flows, or probably simulate the cash flows based on the assumed distributions, and finally get into the computation of liquidity at VAR, liquidity at risk, which is the LAR. And one more thing that needs to be looked at in this scenario is, especially we talk about a crisis situation. Whenever we use the word crisis, the behavior is not the same as normal. These are two different worlds altogether. Even when we talk about liquidity or various things, in a crisis situation is not the same as normal. And when we define a crisis, probably some event could have happened, like some asset prices have fallen or some defaults have occurred in some sector. So there could be some small or big event that is triggering this crisis. And because of that, more and more sell-offs happen, the spreads get wider, the liquidity in the market falls. Actually, during that time, the liquidity is more and more needed. But during that time, we see that the liquidity falls, which will result in an increase in the liquidity risk. So during that case, if I have to measure the liquidity at risk, we can use either a crash metrics kind of a mechanism, or a crash or a crisis scenario analysis kind of a mechanism to assess what is the level of liquidity or what is the crunch in liquidity that is coming because of the crisis. And what we see is, if at all I am using a crash metrics kind of an approach, I am going with, let's say, okay, in a normal scenario, if I am talking about the profit or loss on a derivatives, okay, when I talk about the profit or loss, what is the value of profit or loss equal to some delta times the change in the asset price, delta gamma position. delta times the change in the asset position plus gamma by 2 times the change in the asset position square. Now what I say is take the derivative of this with respect to the delta S. Derivative of it with respect to delta S. So this becomes delta plus gamma by 2 into 2 delta S. So from here you will get delta S is equal to, this first derivative is 0. I want to find out the maximum loss that can occur in this position. So from here I am getting that delta S is nothing but minus delta by gamma. And I substitute this into the equation. I get my profit or loss P equal to delta into delta S is minus delta by gamma plus gamma by 2 into delta S square is nothing but delta square by gamma square. So this is going off. So this comes out as minus delta square by gamma plus delta squared by 2 gamma. So which is working out to minus delta squared by 2 gamma. What does that mean? The maximum loss that can come during this process is minus delta squared by 2 gamma, which can occur when the change in the stock price is minus delta by gamma. So if the delta is around 0.5 and gamma is around 0.2, what we are saying is if the change in the price is somewhere around 2.5, which is like an extreme fall somewhere, if the change in price is by the extent of 2.5, we can assume that the maximum loss can occur and that the value of the maximum loss is minus delta squared by 2 gamma. So you multiply that with the margin requirement to compute the LAR, because when the price can fall to this extent, you have to, the margin has to be replicated back. So the margin requirement times this maximum loss could be your LAR. And in some cases, people don't compute this kind of an aspect. If at all for securities, we are able to find out an expected shortfall kind of a measure, that whatever the expected shortfall that is computed, you multiply by the margin requirement to arrive at the LAR. And sometimes even more few complications can be built in into the model. Not so simplified kind of models. You can find out the correlations between the various credit events, and you can identify the correlations between the timings of the various credit events. All these things can be built as a part of the crash metrics kind of model. So these are more of probability intensive, calculation intensive kind of models. But on the other side, I may get into a simple crisis scenario analysis, which is more of a subjective and a conceptual kind of a model. So here we are trying to identify, okay, what has caused the crisis? Which all problems have caused the crisis? What are the various causes associated with each of the problem? So try to understand the interactions between the various factors that might have caused the crisis, various complications involved, which is what could result in high levels of subjectivity into this process, right? So these are some of the mechanisms that are available to us to really understand the liquidity at risk, or probably try understanding, getting a basic hold in terms of understanding the liquidity risk, and trying to do some kind of workout on computations of the various measures of liquidity risk. I hope this session has given you some level of decent insight into the same. In case you have any further queries or clarifications into it, please get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.